So we're investing across the whole spectrum in real assets. That includes everything within the natural resources, infrastructure, renewables, et cetera. And so we've been thinking a lot about and investing and based on some themes that we think about. Obviously, the big one is the energy transition, the movement, and moving away and shifting away from fossil fuels to the renewables. But also, another dynamic that we've been taking into consideration is the energy transition as a whole, moving from centralized assets to more decentralized assets. So what does that mean? So before you would drill or mine, send it to or transport it into a power generation that would then be able to transmit it. And now you're able to create energy on your solar panel on your roof of your home and able to capture it. Sometimes you have the battery storage at a local municipality so that it's closer to the end user. So we're thinking about a lot of those transitions in the market on a very, very broad basis. Obviously, the other dynamic, especially with COVID, is the working from home dynamic and all the necessary everything that you need necessary to be able to make these things available so we can work on Zoom. Everything before was so much oriented to the center cities, right? And making sure you had your data storage, et cetera, in near your cities and so forth. So we've been doing a lot around that, investing a lot on the fiber side. We've done a couple of deals in that area as well. And then I would just last say the concept of sustainability is another big area that we've been focusing on as well, where, I always say I'm a Californian, so I've always been taught to conserve and not overuse any resource like water, right? And so we think about all the opportunities that come from sustainability. Maybe it's even smart water metering and investments that allow the end user to conserve more and make it easier for them to do, whether it is an individual, but on the business side as well. So always in the real asset side, we talk about how a lot of risks have shifted for many of us who've been investing in the sector in the last kind of 10 plus years. The risks of 10 years ago or 15 years ago have shifted a lot in how we invest today. I mean, the obvious one is, and I think I know I've hit on the climate change, but the climate change is an issue, right? I would say the second thing is, regulatory issues have changed, right? Especially when you think about your counterparty risk with, it could be a local utility, local municipality. The fiscal pressures of a lot of them makes it so, they're not necessarily that credit quality you expected it to be 10 years ago. So we think about how it's climate, but it's also a big regulatory. And I think we are all as investors taking on more market risk. And what does that mean as we think about real assets as contracted assets, but you're not able to contract, in that long-term with those long-term, like we used to, right? There are a lot of the contracts you see are much shorter in nature. So as an investor, maybe 10 years ago, you were accustomed to having kind of these long contracts, 10 plus years. Now we're finding those to be a lot shorter. So therefore, you're taking on more market risk as well and contracting risk. ESG is such an interesting topic. I mean, I've been practicing ESG even before it was called ESG, because if you think about what ESG is ESG helps you mitigate risk. Well, it helps you identify potential risks in any investment, but also helps you mitigate risk. So I think that there is a lot more visibility, more importance being placed from an investor standpoint, which whether managers or investors like ourselves are thinking about it, we're starting to notice it become an important part in how we think about, and I think about the operations of a business or operations of an asset, but also more importantly, the terminal value. How is an asset going to be perceived? Because especially on the real asset side, you do obviously generate some cash yield throughout the life of an asset, but so much of that your return is really dependent on that terminal value. So if it's an asset that I would call, score on the higher ESG, positive ESG, obviously that helps you from an exit standpoint. But there are some assets that I think are more on the gray, where you got to really think about what does that look like in 5 or 10 years when you're looking to exit. I think overall on the real asset side, people are, I'm seeing a higher allocation to that, especially as you think about investors are creating more of these opportunistic buckets that are, taking away assets from, your traditional fixed income. And then they're putting it in these opportunistic buckets where you're finding real assets kind of playing a big role, and real assets beyond kind of your traditional oil and gas, right? Or anything within natural resources. So I do see that overall there is that increase. There is that search for yield, where based on especially where interest rates are. Um, and therefore, this is a great opportunity for investors to generate some yields, but also have some kind of longer term higher returns based on kind of that, that longer term aspect in the intrinsic value of these assets that you're holding. Um, and then, related to that, I would say a lot of credit strategies, alternative credit strategies. So depending on, whether it's private equity or real assets, I'm seeing a lot more interest in that area of focus. Again, given the dynamic of where interest rates are at. I do think that the personal connection is still going to be an important aspect, post COVID, whenever that is, and hopefully it's sooner than later. But I think that it's been fantastic for our industry to have Zoom. I think one, it's an equalizer. So it's an equalizer for any manager to connect with any institutional investor. You don't have to travel to every corner of the world to meet with all these investors. I think investors are very much now open to doing a virtual meeting, Zoom meeting. And I think that's going to help a lot. It will help a lot. I do think as well that investors are getting more accustomed to even now shorter meetings. So, when you would have your first meeting in person, it was definitely an hour. Sometimes it would creep to be a little bit longer than that. These initial meetings have been compressed, right? Because of Zoom, I think because all of us, there's more of a demand for our time, and every minute is accounted for in our schedules, right? So I think we'll continue to see that, but you'll never be able to replace that face to face, especially in our industry where you're committing 10 to 12-year money, right? You're making these allocations and you're investing with managers for a very, very long time. So that component will still exist. At some point in time, it's just at one point in time in people's due diligence process, will they require a face-to-face meeting?